Hey, I want to welcome everyone back to Mortgage Mastery Theater, hosted by Cleveland Street Mortgage. Today we're going to get kind of a twofer. We're going to be talking about interested party contributions, or what is more commonly referred to as seller contributions when you're negotiating a purchase on a contract and the seller agrees to pay some of your closing costs. That's kind of the most common application. And we're going to talk about an important update to that because technically, the technical term from an underwriting guideline standpoint, and Fannie and Freddie set these guidelines, are interested party contributions, or IPCs. And both Fannie and Freddie limit those. And we're going to talk about that generally. And this may feel like it's a little bit in reverse because I'm going to give the update first before we talk generally about this. And if you don't know kind of what they are or why they matter, maybe this update won't feel so important. But I want to get that out of the way first because it is very current and it's on a lot of people's minds right now. Recently there was a major lawsuit, a class action lawsuit against real estate agents, National Association of Realtors, alleging that they were engaged in anti-competitive practices by requiring listing agents who list for a seller to offer a buyer's agent commission as well when they sell a property on the NMLS. And you've all heard a lot about that probably by now if you care about it at all. And I don't need to rehash that there, but the long and short of it was that they're no longer going to, listing agents are no longer going to be able to require that sellers offer a buyer side commission when they list with the NMLS, and B, or even publish that there is one available when they put that in the listing notes. So, and that raised the question amongst us lenders and a lot of realtors as well, saying, okay, now, in the past, that's just been a given. It's not been a part of the contract. It's a contract between the seller and the seller's agent. It doesn't come into the purchase and sale agreement other than there's a commission disbursement form that they give to escrow and say, here's how you divide the commission. But that never entered into the loan calculus. It was never something that underwriting had to review. But now what if you get a situation where the listing agent, the seller, doesn't offer a buyer side commission? But then in the course of negotiations, the buyer says, look, I'll pay you X amount for this deal, but you have to pay my agent 2.5%. That's a part of the negotiation. And maybe underwriting would look at that just like they look at and say, okay, we'll buy your house, but you have to pay $5,000 toward my seller's closing costs. Now, in this case, they're going to say, but you have to pay $15,000 toward my buyer's agent commission, which now it's become very clear and contractually obvious that that's a buyer cost. Whether or not the seller pays that as a part of the negotiation, it's a buyer cost. And so will these costs now that have historically and always been paid by the seller out of the seller side, vast majority of the cases, now that this is going to be more contractually clear that this is a buyer's obligation, is this going to come under the rubric of interested party contributions and then fall under those limits? And you can see that the problem there's one is that, depending on what kind of property you have, you may not be even allowed to have that much in interested party contributions, depending on, and we'll talk about that a little bit later, how different property types, different loan types allow different percentages of the purchase price for the seller to pay, right? So you may not even be allowed to cover that much. Okay, but if you are, does that count against your limits that you otherwise? What if you negotiate that the seller, like they always have, is going to pay for the buyer's agent's commission, and in addition you want $10,000 from the seller toward your closing cost? You have to add those together, and they both together have to fit under the limit. And thankfully, in what can only be described as lightning speed fashion for a government connected agency like Fannie and Freddie or agencies, they came out and made it very clear. They said, look, we are not going to treat these as interested party contributions under that rubric, subject to these limitations. And you can see in the highlighted section here, they say here, if a seller or seller's real estate agent continues to pay the buyer's real estate agent commission in accordance with local common and customary practices, these amounts are not required to be counted towards the IPC limits for the transaction. And then we're all very thankful for that, because that was on everybody's mind. What if that comes up? Then how are we going to negotiate that? How are we going to be clear? Is it going to be underwriter discretion? And if it's underwriter discretion, then many underwriters are just going to take a very defensive approach. Now, notice this just came out, right? This just came out, but that settlement hasn't been around that long. And so there's not a lot of deals that have kind of come under that so far. So very thankful that Fannie and Freddie came out with this clarification. And it's a common sense clarification, right? It's a common sense clarification that says, look, we're not changing the way these are treated. Sellers have always paid for these. It's common practice. If they continue to do so, even if it becomes more of an explicit part of the negotiation between buyers and sellers, and it's more contractually clear that the sellers are actually paying a buyer cost, it's customary. It's not something that's outside of the norm. And so we're going to continue to treat it that way. So that's the update, and that's for everybody. For realtors, everybody should understand that's a really important clarification from Fannie and Freddie, and we don't have to worry about that. Now let's talk about interested party contributions in general. This is kind of the twofer part of this video. Again, interested party contributions. You ask somebody, do you know what an interested party contribution is? In the context of real estate, most of them are kind of go, huh, what? It's not a term that just kind of rolls off the tongue that people use a lot. Most of them just call it seller concessions or seller paid closing costs. And but the technical term is interested party contributions, and the reason for that is there's a number of different parties that can get caught up in that. Interested party to the transaction, can be the realtors involved, can be the seller. Can be other parties conceptually could be involved, but the vast majority of time it's seller agreeing to pay some of the lenders, some of the buyers, closing costs and prepaid expenses, and these have always been subject to limits. And on the one hand, you can think about that these limits make sense, right? These limits make sense because at some point, when you think about it, if a seller says, "Look, I'm going to sell my property for $100,000, but I'm going to pay $10,000 of your cost in the process of selling you this," they've really sold it for $90,000, and that's how the seller thinks about it. They don't really care about the classification of things; they're just thinking about the net, right? Here's what I'm selling it for. I'm selling it for $90,000 because really the price says $100,000. But I'm paying 10 of your closing costs or whatever, so I'm really selling it for 90. And that's really the reality. But for purposes of regulation and industry practice and custom, as long as those seller contributions stay within reasonable limits, then the lenders don't view it that way, and also importantly, the appraisers don't view it that way. They're largely willing to allow those sorts of contributions to be factored into a contract without them impacting the value. Because for example, when an appraiser goes out to appraise a property, a lot of people are surprised, thinking that, or a little cynical and say, well, why did I send the appraiser? They just came out in the purchase price anyway. Understand that is the definition of market value, right? The definition of market is what a willing buyer and a willing seller, both reasonably informed, neither under compulsion to buy or sell, agree upon. That's the definition of market value. And so the vast majority of time, whatever the market is determining, whatever the contract price is for that property, is the market value. And the appraiser is not really out there to abstract a better version of the market value or what the market value should be for a property. The appraiser's job is really just to go out there and make sure that value that was arrived upon is reasonable in light of all the other activity that's going on around it. And so, yes, there is a very detailed process that they go through, but a lot of times they're guided heavily by what the market actually dictated, and they're just there to make sure that nothing looks awry, amiss in the transaction. And so they compare it to other properties similar that sold in a reasonable time frame, reasonably close, reasonably like that property. But their understanding of that value might be impacted differently if it weren't for these guidelines, right? They might look at it and say, well, look, you sold it for $100,000, but then the seller's paying $10,000 of your closing cost, so really you only sold it for $90,000, so I'm going to give it $90,000. And that would be a big problem for a lot of people out there borrowing money because, of course, lenders' guidelines are based upon whatever the contract price is, whatever it's the lower of the contract price or the appraised value. So if the appraiser comes out and says, well, that $10,000 seller contribution really lowers the market value to $90,000, then we'd have a problem. If you're going to put 20% down, if you're going to borrow 80% of $100,000, and now this appraisal comes in and says, no, it's only appraised at $90,000 because the seller is paying $10,000 of your closing cost, then that lender will look and say, well, look, I can only lend you 80% of $90,000. Or if you're going to borrow $80,000 anyway, then it's $80,000 divided by $90,000, and that's a loan to value of 83 or whatever that number is. And now we have mortgage insurance and all those other things, right? So appraisers have relied upon this, and Fannie and Freddie have have regulated this and said, look, up to a reasonable amount, we will allow these seller contributions, and appraisers have largely gone along with that. So what are those limits? And so, what I'm going to show you here is the limits on how much a seller can pay or an interested party can pay on behalf of a buyer or seller range from 2% of the purchase price to 9%. Now, 9% is a huge number, right? Let's think about my market. I'm in a market right now where the average purchase price in my Seattle market is about $850,000 almost. So think about that. That's $85,000 of seller contributions, rough. It's not quite that. I'm using simple math, right? I'm rounding everything, right? So let's say it's $80,000 that the seller could pay. Well, first of all, remember that those interested party contributions have to pay for closing costs and prepaid expenses. So maybe maybe these interest rates are running high, and you want to buy down the rate, and you'll pay a lot of points to buy down the rate. Maybe you could start to run those numbers up pretty high, but that's a huge number. And even though Fannie and Freddie allow up to 9%, that doesn't mean the appraiser has to accept that, right? As we mentioned earlier, that the appraisers have largely gone along with that, but they still have to filter that through their surrounding market value. And if you have a property that's $800,000, but the seller is paying $80,000 of your closing costs, that may impact the appraiser's value as well. So just understand that it still has to appraise, and they have to be actual closing costs and prepays that goes to, right? But if let's say you do get that situation, Fannie and Freddie would allow up to 9%. Now that's only if you're putting at least 25% down. And with the primary residence is the only conventional loans, not Fannie, not government loans, Fannie, FHA, VA, USDA, those are all different, and we'll talk about those in just a second. But for conventional loan, primary residence is the only loan type that differentiates between loan to values. How much you put down dictates how much the seller is allowed to pay. If you put at least 25% down, then they can go 9%. If you put 10% down, or more, then they can pay up to 6%. If you put less than 10% down here, then the seller can only pay 3%. And that could come into play, right? If you're putting less than 10% down and you're buying an $800,000 property, well, that's that's still a pretty large number. That's still $27,000. So not likely going to limit you significantly. Maybe it's going to limit you more if you're buying a cheaper property. Let's say you're buying a $400,000 property and you're putting less than 10% down. Now that's $12,000, that they're allowed to contribute. And so just be aware of those limits. Now, if it's an investment property, it's 2% across the board. And remember, what we started off talking about this update up here. Well, remember, a typical agent's commission is, let's say, between 2.5%, 3%. Right, and let's say that the seller in this this transaction that you're engaged in, you're buying an investment property, and the seller says, "Look, I'm not going to offer a buyer side commission on this." And then in the course of the negotiations, the seller says, "Okay, I'll pay your realtor's commission. It's going to be 2.5%." Well, investment properties are limited to 2 total. So if that were the case, if Fannie and Freddie had not come out with this notice saying, "Look, we're not going to count those as interested party contributions," that deal would be in a lot of trouble because of the way they were structuring that. Or let's say it was only 1%, but then the seller also wanted to pay some of the buyer's closing costs. Those things would tend to be more of a factor. But here they're not. But just know that on an investment property, anytime you're buying an investment property, the seller can only contribute up to 2%. And then with with FHA and USDA, they're 6%, and that no matter what loan to value, however much you're putting down, USDA goes to 100%, FHA goes to 96.5%, and so all across the board, the spectrum, you can have up to 6% seller contributions with those. And then VA is different in 2 ways. One is 4% is their maximum, is their cap, and again, that's across the board. They lend up to 100%, of course, on VA. But 4% is their max. But one little twist about VA that can be helpful is VA allows, in addition to closing costs and prepaid expenses, like for VA in some situations, you can pay off a veteran's debt in order to help them qualify. So if you got a veteran that has a car loan that's got $400 a month payment on it, but maybe doesn't have a huge balance left, that can be negotiated into the deal where the seller can contribute toward the veteran's cost up to 4%, and they can use that to pay off that debt to qualify. So that's a little bit of a wrinkle. Final thoughts on this, and these are things we've already talked about. I just want to summarize here again. Must be used for closing cost or prepaid expenses, except for VA, that you can also use that for payment of debts. But just remember that you're not just negotiating some random number that can be used for anything you want. It has to be toward closing costs and prepaids, and that can be limiting to some degree, right? Because if you negotiate a seller contribution of, let's say it's $10,000, but you want an interest rate that also generates a credit towards your closing cost, and so that now you only have like $7,000 of closing costs and prepaid expenses because of the interest rate you wanted to negotiate, then you don't have enough closing costs and prepaids for that seller contribution to cover. And that can mean you leave that money on the table. Seller doesn't have to pay it because typically the wording of the contract says that the seller agrees to pay up to, say, $10,000 toward the buyer's closing costs and prepaid expenses, right? So it's specific as to what it can go for, and it's worded as up to, right? So it's only up to whatever you actually have. So just be aware of that when you're negotiating those things. It can be a limiting factor, but also, so you want to make sure you don't leave that money on the table. And then also remember just the property must appraise. So that's it right now. Thanks so much for listening, and look forward to your comments. Please like and subscribe, leave me reviews, any of that's helpful. I'm licensed in Washington and Idaho, but I have a network of lenders all across the nation that are great lenders that I can refer you to. I can't be commissioned on that. I can't get a referral fee. It's illegal for us to do that. Unlike realtors, they're allowed to do that across the nation, but we're not. It's just not legal for us to do that, so I don't have that. The best I can get out of that is I simply get the goodwill of those people that I refer to, and maybe they'll reciprocate someday. They'll remember me. But happy to refer you to good lenders across the nation, and most of your questions are going to be the same no matter what jurisdiction you're in, what state you're in, so I'm happy to answer any questions I can. Thanks so much.